This is episode 95 of Zen and the Art of Real Estate Investing with my guest, Maxwell Wu. Maxwell is the founder of Fulcrum Lending, a direct balance sheet lender for multifamily properties nationwide. He has underwritten real estate acquisitions totaling over $10 billion. Maxwell, welcome to the show.
Thanks for having me, Jonathan.
Yeah, I'm excited to talk to you. So when did you get interested in just real estate as a whole? I know you've been in prop tech and on the lending side, but when was real estate something that really became interesting to you for your business?
I mean, I would say, I've been in real estate broadly for over a decade, and that really started in the private equity world, focused on distressed real estate in particular, distressed for control transactions. Started off in the fund management side, managing equity for, distressed funds, but also for bonds. And then ultimately, moved into the acquisition side. I really like the management side better though. And really, took an emphasis on understanding how to create, platform value, which is really all kind of a private equity fund is. It's another layer of leverage there.
Yeah.
So, that started about, over a decade ago. Since then, went into, investment banking and venture and company building, but it's always been with a focus to real estate. I think that's a really important thing too, is just, choosing one thing, focusing on that, going really deep. And, I often say, success in many things is a function of time. So if you're willing to put the time and the effort to make that happen and to become an expert in it, good things will follow. And it's just about, trusting that process. So I've been fortunate enough to, have held positions, that gave me a viewpoint, a vantage point, if you will, into very unique opportunities, and also just get to work with really smart people and understand how they think about investing and investing through multiple cycles. Right.
Yeah.
That we're at a very unique point right now, where we are in the cycle, and, a lot of people are just trying to figure out where things are, right? I think many folks, in active management allocation positions, they may have seen, 2008, 2009, from afar, but, I think the prior cycles, tech bubble, oil crisis, 80s, those are all really important data points that one must factor in understanding how, the overall investment, let's call it the investment world, overlays on top of just, the sticks and bricks of it, right? The real estate, the fundamental value piece of it. And that's what I've always been focused on, is the fundamental value there.
So there's other things to focus on right now. Are you finding that, like, obviously we know the answer to this, but multifamily transactions across the board are very much down right now. Is it fully in effect just because of the rates, or are there other things at play with buyers and sellers not meeting on price and value?
Yeah. I mean, I think, to your point, yes, bid-ask spreads are still very wide, but, part of where we are in the lending world is also a function of where equity thinks, prices will go, right?
Yeah.
We're cash flow-based lenders, right? We're looking at the asset, looking at basis, we're looking at the debt yield being thrown off the property. That's all really important. But it's just about what's holding the seller's feet to the fire to make them transact, right? I think, going back to even in COVID, right? Rates ended up cratering. People took out a lot of floating rate debt. They purchased rate caps. Those things are burning off. They got into loans that were, full term IO or partial term IO, and those are burning off. So that's bringing people to the table and forcing some transactions in. But I think for the other half, right, that have some duration, some longevity on the debt that they have, that have longer term patient capital, those ones will continue waiting to see kind of where the world ends up settling. Cause, real estate, there's a camp, right? And I'm in that camp where I think cap rates really do follow interest rates. So if you're a
Yeah.
real estate person, right, you really do have to be following the markets there. I'm not saying that, put an overwhelmingly, weighted, weighted, position on that. But for the most part, markets do play a large role in where value is, right? So
Yeah.
if I think fundamentally intrinsic value for a property is at X and the market thinks it's Y, right? That's the reason why there's that spread, that bid-ask spread.
Yeah.
But as there's a reason for people to come to the table, then transactions will happen. The thing is, right, compared to the last crisis and the crisis before, the fundamental underwriting, the fundamental value in a lot of these assets, it's a lot stronger, you know?
Mm,
There's just a lot more data, a lot more experience, a lot more regulation, frankly, that goes
yeah.
in forcing people to underwrite more responsibly and with a little bit more sanity in what it actually costs to operate these things and what you can actually push rents to.
Can you just explain what floating rate debt is? Because it became so popular and now it's become the real problem where that's where, where people are looking to hopefully transact on that. Why did people choose that? What is it? And how is it affecting the market now?
Yeah, I mean, floating rate debt is, it's a variable interest rate you're taking on as a bond, right? The the intrigue is that, you can borrow at a lower today, but the trade-off is, okay, you don't know where rates are going in the future, right? There's two sides to every trade, right? And there's an opposing viewpoint on someone selling versus someone buying, right? So taking on floating rate debt, it's attractive for those that kind of need short-term bridge and are willing to kind of take on that risk of duration and say that they can confidently take a property, improve it, push rents, and refi into a fixed rate loan at a higher valuation, right?
Right.
That's the reason they're getting into variable rate, floating rate debt.
Is
And
it the same as like for regular, for regular home buyers, adjustable rate mortgages, or is it different? I mean, is the floating debt a little bit even more risky than ARMs? Because I don't consider ARMs to be that risky as long as you know when you're going to leave. But I think that floating debt might have a couple other things going on.
I mean, I wouldn't say it's any, I mean, if you perceive resi, floating rate, these arms, as not too much risk, and then I would say that transfers similarly over to the commercial side. It's just a larger property. Um, but I mean, our viewpoint is, we don't want to issue that. We don't want to put borrowers in that potentially precarious position. We are fixed rate lenders. We're also big believers in not overburden property, right? We don't want to charge exorbitant interest rates where it immediately puts the property underwater day one, or where the DSCR, the debt service coverage ratio, is below a 1.0,
Right.
times coverage. So, we're not in the business of loan to own or taking keys back there. We very much want to just clip a healthy rate of return, and go home, and make
Yeah.
sure that our borrowers or sponsors are responsibly implementing their business plan and more importantly, successfully implementing it.
Yeah. Let's just talk about underwriting for a second, because I think like obviously on the lender scale, it's something obviously you're doing to qualify the loan and the participant. But I feel like investors sometimes don't take underwriting as serious. Obviously, like you're very experienced investors, they know how to underwrite. But why is underwriting so important, especially on these multifamily assets? For these newer ones, even like we said, they have a lot of money, they want to get into large scale multifamily. But like if you don't understand the underwriting portion, you could miss something that could take you 20 years to fix, right? On these buildings, they're so big, so many units.
Yeah, I mean, I think if I heard your question right, kind of why underwriting is so important, right?
Yeah, well, like all the ways that people can mess up.
Yeah, I mean,
Oh,
exactly. I mean, you miss a unit, right? You mess up you fat finger the occupancy, you fat finger something, right? Maybe the data isn't perfect,
yeah,
maybe the data that you're getting from all your other OMs, massively overstate rent and, and really massively understate, expenses, right?
Yeah. Yeah.
So if it's, good data in, good data out, right? Bad data in, bad data out. So it's really focusing on the quality there. But I think in terms of just fundamental underwriting, just kind of spot checking or just making sure you're doing it right, looking at, properties in the proximate area that, are having expenses, at an average rate of X versus Y, right?
Yeah.
You'll understand that. But yeah, I mean, underwriting is fundamental. It's value follows earnings. Earnings is our NOI, right? And if that NOI doesn't happen to be the number that we initially underwrote, it's kind of like a stock, right? And if you read, same financial news, you hear Microsoft, this is X earnings, right? There's stock tanks, right?
Yeah. Right.
Similarly, right? That's the same with real estate values. All of a sudden that, your earnings actually don't match what was projected, right? It's a really massive hit to value of property.